The stock market looks strong right now. AI stocks are still making headlines, the biggest companies keep getting bigger, and major indexes are sitting near record highs. But here's the uncomfortable question. What if the good news is already priced in? Some investors believe the U.S. stock market may be near the top, not because the economy is definitely about to collapse, not because AI is fake, and not because anyone can predict the exact day of a crash. Nobody can do that. But when valuations are high, when only a few tech giants are carrying the market, and when almost everyone believes the same bullish story, that is usually when smart investors start paying closer attention. Because the most dangerous moment in the market is not always when people are scared. Sometimes it is when everything feels too easy. Today, I'll give you a simple 5-question framework to think about whether this market is getting too expensive. We'll look at valuation, concentration, AI expectations, interest rates, and market behavior. This video is for education only. It is not financial advice. Let's break it down in simple English. Before we start, I want to ask you one question. Do you think the stock market is in a bubble? Or does this bull market still have room to run? Comment bubble or bull market. I want to see what side you are on. The first warning sign is valuation. Now, valuation sounds like a boring Wall Street word. But it really means something simple. How much are investors paying for future profits? Look, high valuation does not mean the market is going to crash tomorrow morning. It is not that simple. But it does tell us something important. Expectations are high, very high, and when everyone expects perfection, there's very little room for error. Think about it this way. If you buy a normal business at a fair price, it just needs to do okay. But if you pay a massive premium for that business, it has to perform extremely well for years just to justify the price you paid. The same thing applies to the whole market. When stocks are expensive, investors are not just buying today's earnings. They are buying a future that has to go right. Strong earnings, cooling inflation, stable interest rates, continued demand for AI, and no major surprises. That is a lot to ask. This is why some investors look at numbers like the PE ratio and the Shiller CAPE ratio. These numbers are not magic. They will not tell you the exact day the market turns. But they can show whether the market is cheap, normal, or expensive compared with history. And right now, many valuation measures suggest U.S. stocks are not cheap. That does not prove a crash is coming. But it does mean the market is priced for a lot of good news. Self-check question. When you buy a stock today, how much future growth are you already paying for? If you have no idea, be careful. Summary. High valuation does not predict the day of a crash, but it makes the market more vulnerable to disappointment. The second warning sign is market concentration. When people say the stock market is going up, they usually mean indexes like the S&P 500 or NASDAQ. But here's the thing. An index can look strong even when only a small group of companies is doing most of the work. Think about a basketball team. The scoreboard says they are winning, but then you realize only a few star players are scoring almost all the points. The rest of the team is barely moving. That is what some investors worry about in today's market. The index looks healthy on the surface, but a large part of the strength has been connected to mega-cap technology and AI-related companies. NVIDIA, Microsoft, Apple, Amazon, Meta, Alphabet, Tesla. To be clear, these are not weak companies. Many of them are extremely profitable. They have strong businesses, huge cash flow, and powerful positions in the global economy. But that is not the point. The risk is concentration. If too much of the market depends on a small group of giant stocks, the whole index becomes more fragile. Because now, the market is not just betting on the U.S. economy. It is betting that a few massive companies will keep delivering exceptional results, again and again, quarter after quarter. And if one or two of those giants disappoint, the whole index can feel it. Self-check question. Is the market really broad? Or is it mostly a bet on a handful of tech giants? Summary: an index can look diversified, but still depend heavily on a few winners. The third warning sign is AI expectations. And this is where things get tricky. Nobody is saying AI is fake. The technology is real. The spending is real. The excitement is real. And yes, some companies may become much more valuable because of AI. But investing is not only about whether a technology is real. It is about the price you pay for that future. A powerful technology is not the same as a profitable investment. Never confuse the two. Here's the real danger. What if AI succeeds, but it just does not happen fast enough for Wall Street? What if companies spend billions on chips, data centers, and AI infrastructure, but the actual revenue takes much longer to show up? What if customers adopt AI more slowly than expected? What if competition pushes prices down? What if the winners are real, but investors already paid too much for them? That is the risk. Not that AI disappears, not that the technology fails, but that the market expected too much, too fast. We have seen this movie before. The internet was real, but the dot-com bubble still happened. Electric vehicles were real, but many EV stocks became too expensive. Crypto technology was real, but many crypto assets collapsed. The lesson is simple. Real innovation can still become overvalued. Self-check question: are you investing in real profits or just a powerful story? Summary: the danger is not AI failing. The danger is investors expecting perfection. The fourth warning sign is interest rates. This part sounds technical, but the idea is simple. When interest rates are low, investors are usually willing to pay more for future growth. Why? Because when safe returns are low, future profits look more attractive. That is one reason growth stocks often do well when money is cheap. But when rates stay higher for longer, the math changes. Investors suddenly have alternatives. They can earn more from safer assets. Companies may face higher borrowing costs. Consumers may feel more pressure. And future profits become less valuable in today's money. In plain English, higher rates make expensive stocks harder to justify. This does not mean the market has to crash. Strong earnings can still support stock prices. AI growth can still attract capital. And the economy can remain stronger than bears expect. But higher rates reduce the margin of safety. When valuations are already high, investors become much more sensitive to bad news. A weaker earnings report, a hotter inflation number, a slower growth forecast, a warning from a major company. Any of these can trigger a sharper reaction than people expect. Self-check question: if rates stay higher for longer, does your stock still look attractive? Summary: high valuations are easier to support when money is cheap. They are harder to support when rates stay high. The fifth warning sign is market behavior. A lot of beginners think a market top looks like a sharp mountain peak. The market goes up, it hits the highest point. Then boom. A huge crash. But real life is usually not that clean. A market top is often messy, slow, confusing, and exhausting. Some stocks start dropping quietly while the main index still looks strong. Volatility increases. Bad news starts to hurt more. Good news barely moves the market. Leadership gets narrower. And little by little, the market shifts from confidence to doubt. That is why market tops are so hard to recognize in real time. When you are living through it, the story still sounds good. The companies still look strong. The headlines still talk about innovation. Analysts are still raising price targets. And many people believe every dip is a buying opportunity. That is how investors get trapped. They are not buying because the price is attractive anymore. They are buying because the story still feels powerful. But stories do not protect you from valuation. Narratives do not protect you from earnings risk. And hype does not protect you from market cycles. Self-check question: are you buying because the price makes sense or because the story still feels exciting? Summary: a market top is not a date on a chart. It is a change in behavior, leadership, and expectations. Now, we need to be fair. Warning signs do not mean a crash is guaranteed. This is where a lot of bearish arguments become too simple. Markets can be expensive and still go higher. Valuations can stay high for a long time. Strong earnings can support stock prices. AI can create real productivity gains. Big tech companies can continue generating massive cash flow. And if inflation cools, interest rates may become less of a problem. So the balanced view is this. Yes, the market may be expensive, but expensive does not automatically mean immediate crash. The better question is not, will the market crash tomorrow? The better question is, what has to go right for this market to keep going higher? If earnings keep growing, if AI spending turns into real profits, if inflation stays under control, if interest rates fall, and if market leadership becomes broader, then the bull market may continue. But if too many of those things go wrong at the same time, the market becomes much more vulnerable. Summary. This is not a crash prediction, it is a risk framework. Pause here. If you remember only one part of this video, make it this. 5 questions before chasing the market. 1. Are valuations high compared with history? 2. Is the rally broad or driven by only a few giant stocks? 3. Are earnings growing fast enough to support the price? 4. Are investors ignoring risk because the story feels too powerful? 5. What would make the bullish story break? That last question matters most, because if you cannot explain what could go wrong, you may be too attached to the story. Do not ask only whether the market can go higher. Ask what has to go right for the market to keep going higher. So, is the U.S. stock market near the top? Maybe. Maybe not. A market top is not guaranteed. A crash is not guaranteed. But the warning signs are worth understanding. Because the biggest risk in a bull market is not optimism. The biggest risk is blind optimism. Next week, I'll use this same 5-question framework to analyze one of today's most popular AI stocks. Which one should it be? Nvidia? Tesla? Microsoft? Comment the ticker below. I'll pick the one with the most requests. This video is for education only. It is not financial advice. This is MarketMind AI. AI explains markets. You make smarter decisions. See you next time.